Picture your neighborhood Starbucks with its green siren logo, the place you used to grab lattes, meet a friend, or get work done. Now imagine that familiar spot boarded up, a closed sign in the window, and a barista, suddenly looking for a new job. That's the shock. Millions of customers and hundreds of employees are waking up to. Starbucks has announced a major restructuring that will eliminate roughly 900 non-retail jobs and close many underperforming stores across North America, part of a roughly $1 billion plan to reshape the company's future. This isn't a tiny blip. It's a defining moment for a brand that has been a daily ritual for generations. The company announced the plain facts. This week, Starbucks CEO Brian Niccol shared a memo explaining the changes. The company will reduce non-retail headcount by about 900 roles, close a substantial number of underperforming stores, and allocate roughly $1 billion toward the overall restructuring plan. That $1 billion is spread across severance and other employee costs, breaking leases and store closure expenses, and reinvestment in remodels and strategic initiatives. The company says the goal is to streamline operations, speed up service, and reinvest in the formats and markets that are growing. Why this matters? Immediate signals to employees and customers. It matters because Starbucks is more than a coffee chain. It's a cultural touchstone. Cutting nearly 1,000 corporate jobs and shrinking the footprint of stores signals that even iconic brands must adapt quickly or risk being left behind. For employees, the announcement means uncertainty, possible transfers, and severance in some cases. For customers, it could mean fewer options and longer lines at the Starbucks that remain. For investors, it's a signal that the company sees structural problems worthy of an aggressive reset. News outlets and analysts described the move as part of a wider turnaround effort after months, even years of sluggish U.S. sales and shifting customer habits. How big are the store closures? Estimates and context. Starbucks has not published a single final figure in every public piece, but analysts and major outlets estimate the practical impact ranges from dozens to hundreds of closures in North America. Some research notes estimate hundreds of locations could close this quarter. Industry analysts suggested numbers in the low hundreds or higher depending on lease breaks and market strategy, while Starbucks forecasts only a modest net decline in total store count by fiscal year end, because the company has opened new locations earlier in the year. In short, the company will close many underperforming shops. But this is paired with a plan to refocus and reshape the remaining portfolio. What's driving this decision? The economic and consumer picture. There are three big forces driving Starbucks' decision. First, inflation and higher operating costs. Ingredients. Wages, utilities, and rent have all risen, and they eat into margins. Second, consumer behavior changed during and after the pandemic. Many people improved their at-home coffee, set up and cut back on daily premium purchases. Third, competition has intensified. Quick-serve chains, grocery store ready-to-drink coffee, and local specialty cafes have stolen share. Put those together and you get decelerating comps and weeks of weaker than expected sales, which push the company to rethink where it should invest and where it should exit. Analysts say Starbucks is aiming to reduce complexity and concentrate on formats that provide the most profit and customer satisfaction. The internal narrative message from the CEO. In his internal memo, Brian Niccol framed this as necessary regrouping, fewer corporate roles, more focus on stores that work, and reinvesting in the in-store experience and drive-through convenience. Niccol emphasized that the company will try to offer severance and transfer options where possible, and that the plan includes renovating thousands of stores to create a more classic coffeehouse vibe and reduce wait times. The messaging is classic corporate reset language, hard, but positioned as a step toward a stronger long-term business. If Starbucks executes well, this can be the start of a profitable refocusing. If not, it risks eroding brand loyalty. About Starbucks, the union angle and employee reaction. This move comes against a tense backdrop. Starbucks has been confronting unionization efforts in the U.S., with hundreds of stores voting to unionize over the last year. Labor advocates and Starbucks Workers United have criticized the company's decisions in the past. arguing that corporate decisions too often prioritize costs over frontline workers. The union response to these latest cuts has been predictably sharp. They say the focus should be on supporting in-store staff and improving workplace conditions rather than cutting corporate roles that can still impact store operations indirectly. Starbucks insists union status did not drive store selection for closures. But in the court of public opinion, any workforce reduction at a company with active union organizing becomes a political and PR challenge. Financial specifics, costs, write-downs, and shareholder impact. The restructuring is expected to cost roughly $1 billion. That includes severance, breaking leases, closing costs, and investment into remodels. Analysts note that while the short-term impact on earnings will be negative because of these one-time charges, the goal is to create a leaner, more profitable, ongoing business. Investors reacted modestly. Shares dipped on the announcement but did not collapse, indicating the market sees this as a heavy but not catastrophic response. Historically, when major retailers or chains take bold restructuring steps, the short-term pain can sometimes be rewarded later if the company cuts the right costs and invests in growth areas. Companies are judged on execution. Where will Starbucks invest instead? The strategic bets. Starbucks plans to double down on formats and markets that drive growth, drive-through and convenience formats for suburban customers. Remodeled stores that prioritize speed and atmosphere. An international expansion, particularly in high-growth markets like China, where the company still sees significant opportunity. The company also wants to push mobile ordering and personalization via its loyalty program, which remains a strength. Starbucks' digital ecosystem and rewards platform are among the best in quick service. The strategy reads like a pivot to efficiency and premium experience where it will be most profitable. If executed well, Starbucks hopes the fixes will restore growth and stabilize margins. Comparisons to other retailers and the retail reset. Starbucks' move is not unique. As consumer habits shift and e-commerce accelerates, many retail and hospitality companies have announced store closures, layoffs, or strategic consolidations. This is sometimes called a retail reset, where companies prune underperforming assets and focus resources on high-performing locations or digital-first channels. Think of larger retail retoolings after previous cycles. Companies that failed to adapt lost relevance, while those that reshaped their model often emerged leaner and more resilient. Starbucks is betting it can be in the latter group. The customer angle: will people stop buying Starbucks? Will customers stop buying Starbucks? Not necessarily. Brand loyalty is strong. Many customers view Starbucks as a ritual. But loyalty has limits. Price sensitivity is higher right now because of inflation. If cheaper alternatives provide comparable taste and convenience, consumers will switch. Starbucks' risk is that it becomes a price premium brand without sufficiently differentiating the experience. The company's plan to renovate stores, speed up service, and invest in app-driven convenience aims to protect that loyalty. But it's a race. Competitors are aggressive, and consumer patience is thin. On-the-ground impact: what it looks like for a local community. For a local neighborhood, losing a Starbucks can be noticeable. The store often functions as a meeting spot, a place for freelancers, and a reliably caffeinated stop. For employees, it can mean job loss or forced commutes to a different store. For landlords, a vacated Starbucks might affect foot traffic and local retail mix. But for some communities, it also opens space for independent coffee shops or different services that might better fit local demand. Store-by-store consequences will vary. Some closures will be in oversaturated or low-traffic locations, while others will hit areas that have sustained long-term decline. The human stories: baristas who've built relationships and customers with rituals, are the hardest to quantify in corporate press releases. Restaurant dive: what this means for investors? Investors should view this as a tactical reset. The closures and layoffs are an admission that previous growth strategies have limits in the current economic climate. If Starbucks can redeploy that $1 billion effectively into high-return areas, the long-term reward could be meaningful. But there's execution risk and reputational risk. Watch the company's same-store sales trends, loyalty program adoption, and the success of remodeled stores. Those will be the early indicators of whether this was a smart pivot or a stopgap that only delays deeper issues. At a macro level, Starbucks' retrenchment illustrates a cultural shift. The premium. This daily habit that dominated for decades is vulnerable in a world where convenience, price sensitivity, and alternatives are contrasting forces. Consumers are more pragmatic now. They seek value and convenience, and are less likely to tolerate long waits or inconsistent service. Brands that once relied on nostalgia and ubiquity must now compete on efficiency and clear value. Starbucks is attempting to do that. But it's a difficult balance between cost-cutting and preserving the premium brand experience. Closing summary, the core takeaway. Starbucks plan to cut roughly 900 corporate roles and close many underperforming stores is a stark reminder that even iconic companies must evolve. This is a painful but not necessarily fatal step. It could be the reset the company needs if executed correctly. For employees, it's a period of uncertainty. For customers, it may mean change in the neighborhood coffee landscape. For investors, the move is a test of management's ability to reallocate capital toward profitable growth. Above all, this episode underscores a fundamental truth in business. Brand power matters, but it doesn't replace the need to meet customers where they are and control costs effectively. What do you think? Is this a smart reset or the beginning of a bigger problem for Starbucks? Tell me in the comments which Starbucks in your area you think might be at risk and how you'd like to see the company change. If you found this breakdown useful, hit that like button, subscribe for more business and retail analysis, and ring the bell so you don't miss our updates on this story. I'll be tracking the fallout closely and bringing you follow-ups on which stores are closing, how employees are impacted, and whether the remodel strategy starts paying off. Thanks for watching, and if you've got a Starbucks story, good or bad, drop it below. Your voice matters in this conversation.